This is a weekly chart of the euro dollar. 133.44 is the current price. And you'll notice that the euro dollar, 133.46 at the moment, is trading at levels we have not seen since May of 2009, and that is huge. Imagine all those traders out there that bought the euro dollar between May of 2009 and now, which is what, 11 months or so, well, 10 months. Over the past 10 months, any trader who bought the euro dollar over the past 10 months and still holds that trade open is now all of a sudden losing money. Every single trader out there that sold short the euro dollar over the past 10 months is now making money. And that's why it's so important to really make note of currencies when they break new 1-year highs or 1-year lows. This is almost a 1-year high or low, and that certainly is important because that gives the market a chance to really become vertical, go up very fast, or in this case, go down very fast. That's when most of the traders get aligned on one side of the market or another. So the question remains, fundamentally speaking, before we tackle the MACD indicator, which is, by the way, the indicator at the bottom of the chart, why is it that the euro dollar is going down? Well, the dollar, Ed, my previous speaker over here, mentioned that the dollar is very strong, and he's absolutely correct. The dollar has been incredibly strong. Capital, and we can attribute that to a couple different reasons. One of the reasons, capital tends to move into the lower yielding currencies like the dollar or the yen under times of fear. And well, some analysts, at least those that I've read from Bloomberg.com, have attributed the recent strength in the US dollar to the fact that, well, there's a lot of problems in Greece right now, in the Eurozone. Well, they're not exactly ready to raise interest rates yet. If you had read Bloomberg.com yesterday, there was a little article, didn't get a lot of press, but I happened to catch it. The Federal Reserve Bank of Chicago president, we have these different central bank presidents, Chicago, San Francisco, etc. The Federal Reserve president from Bank of Chicago had made a statement yesterday saying that he did not expect the U.S. to raise rates anytime soon. 6 months is what they mentioned, and he said he would not be surprised to even see the Federal Reserve not raise rates until 2011. Well, the low rates in the U.S., the low rates in Japan certainly attract capital as other currencies seem to go through trouble. Now, you may ask, well, the euro doesn't have very, very high interest rates. That is true. But on a relative basis, the European Central Bank can still cut interest rates further, whereas the Federal Reserve at 0 to 0.25% really cannot. So fundamentally speaking, so far, despite the good news coming out of Germany, despite the good news that we've read this morning, the euro, for whatever reason, fundamentally is still taking the direction to the downside. More traders are aligned to the short side and very few are aligned to the long side. Now, eventually that'll change. How do we discover these trades, technically speaking? Well, one way is the MACD. The MACD, the moving average convergence divergence, is a very simple oscillator. It measures two moving averages, a 12 and 26 exponential moving averages over a period of 9 or going back 9 periods. Why do they use 12, 26, and 9? I don't know. However, whoever developed the MACD ages and ages ago determined that those were the best settings. I typically like to use the default settings because, well, for no other reason, I like to see the readings of everybody else. With that said, how could we tell, or how can we tell that the euro dollar is going to make new lows and maybe go a little even further? Well, let's see how this works. Let's plug in for a moment some moving averages. And we'll plug in, as we said before, it was a 12 exponential moving average. That's that yellow line that I just threw in there. I'm going to throw in the 26 moving average. This is 26, and we'll change the line to a nice blue color. Okay, so the yellow line at the top of the chart represents a 12 moving average, a 12 exponential moving average. The difference between exponential and simple moving averages, exponential moving averages tend to react a little bit faster to current market conditions, that's all. But very, very close. Well, the yellow line is a short-term moving average, a 12 exponential moving average. The blue line is a 26 exponential moving average. You'll notice while the euro dollar was a nice trend to the upside until we hit very, very significant highs up at 151 November of last year, the yellow line, the 12 exponential moving average, a short-term moving average, was above the 26 or longer-term moving average because in an uptrend, if we count back 12 candlesticks and we take the average closing price of those 12 candlesticks, it's obviously going to be higher than the average closing price of the past 26 candlesticks. That's why in an uptrend, the short-term moving average is above the long-term. you'll notice a change of events occurs when the 12 moving average, yellow line, crosses below the 26 exponential moving average, noting that the trend has changed. Now we have a new trend to the downside. Now, if we had chosen to sell shorts when the moving averages crossed over one another, that occurred January 24th. Unfortunately, that occurred at price levels anywhere between 138 to 142. We certainly missed the top. Exponential moving average, or I should say any moving average crossovers, they tend to occur very late in the game. And if you're waiting for that crossover to occur, you have to assume the fact that we're going to miss a good piece of the move. It doesn't mean that we're going to miss the entire move, but it definitely is going to be a little bit late to the trading signal. In terms of weekly charts, it'll be very, very late.